JJ, the CPA is here. Let's go, let's go. Yeah. Money, 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 money. You know what it be. Tell them all I do is work, cause money never sleep. You never met a CPA quite like me. Nah.
JJ the CPA here. Hope you're doing well. I am pumped to be talking to you today. Thanks for tuning in. Thanks for tuning in later if you're not catching me live. We're live every Monday, 4 p.m. Central Standard Time. I'm Joshua Jensen, CPA. If you're not familiar, I am a practicing CPA, been in the trenches for 30 years, every day still advising clients. And this show, this channel is dedicated to you, the self-employed, the small business owner. Today, we're going to be rocking and rolling, talking about the LLC. And I'm going to tell you this right now, even if you are familiar with the LLC, I'm going to be talking about some of the changes that I think we should be looking at. So fellow tax pros and those that have been in practice a long time or have had your business a long time, I think it's worth tuning in today. So thanks for being here. This is JJ the CPA Small Business Toolbox.
The combination to money making, we got this. JJ the CPA is the master locksmith.
All right. Hey, I think I'm jazzed up because we are in July as of the date that this is being aired, but I want you to be rest assured if you're watching this later in the year at any time, this information applies to you even in the future. But I'm excited that we're kind of past the mid part of the year. We're going into really kind of the year-end planning. You may think, what are you talking about? It's July, it's summer. How is it that you're already talking about year-end? But see, this is the time to really be evaluating what your year is going to be looking at. When you're now looking at your numbers, right? To know your business is to know your numbers. To know your client is to know their numbers. This is a great time mid-year, kind of see where things are at in the first 6 months, reevaluate what you think this year is going to look like. There were a number of tax law changes that were not in play in 18, 19, and 20 because they were, in essence, put on hold with the CARES Act. A number of new laws have come into play in 21. So in 2022, we're just kind of in full swing with everything. There's nothing new and sexy and magical out there, but there's new things that are in play that may not feel as though they're new, but they really are in play in terms of your planning. So get with your tax advisor, get with your clients. I do provide continuing professional education. Each month I'm doing a very specific tax update. I've got some other seminars. I'm going to be doing some continuing ed, kind of going through the rest of the year. But today we're going to be talking about kind of the things surrounding LLCs. We're going to do a top 10 of what LLCs are really all about, things that you probably didn't know. But after I go through the top 10, I'm going to go through with you on a number of graphics. So if we can just show those graphics that we're going to go through after the top 10. And related to this, when we're talking about the LLCs, we're going to talk about what that means. We're going to talk about tax structure, tax planning, kind of some of the things I'm doing with clients, and then maybe a course of action on some of the things that I'm doing with the clients. But let's get into the top 10 for today. Each week I try and do a top 10. It seems like a good way to bring you information. We kind of cover them there at the beginning, but top 10 self-employed LLC facts to know. This also covers for small business. So number 10, the LLC is a legal structure, not your tax structure. So even I was talking with a banker today and we were talking through the structure of a loan, and they said, well, I know that they are an LLC, but how are they taxed? And I said, my gosh, as a banker, for you to know this, that an LLC can be anything and the tax structure is something completely separate, this is huge. And so hopefully you're aware of that. And here's the thing I want you to know. If you've been in business for a long time and you're an LLC and you're filing as a Schedule C, you really need to look at whether or not you need to be an S Corp to save yourself some self-employment taxes. But really keep that in mind. So when you're talking to your advisors, when you're talking to your clients, the LLC really shouldn't even be a big part of your conversation when you're talking about taxes. It should be, how are you filing your business for tax purposes, whether it's a Schedule C, an S Corp, et cetera. That'll make a difference with your bank, your financial advisor. It makes a difference on how you're able to put money into retirement. Again, an LLC is just simply your legal structure. It is not your tax structure. Number 9, the LLC can be taxed as anything, an S Corp, a partnership, a C Corp. You can file Schedule C, Schedule E, Schedule F. It's a chameleon. And, many times when you first start out your business, maybe you were simplifying things. Maybe you weren't necessarily as concerned about this. But if you've been in practice for a while, the benefit also with an LLC is that you can change that tax structure. There's a Form 8832 that is in essence what they call check the box, where you just tell the IRS, you know what, I want to be taxed as something else now. Of course, there are some limitations to that, but here's my point. Many of our clients, when they first start their business, we're always going to have them be an LLC, a limited liability company. And if they're really trying to maybe put their toe in the water, see if this is going to be something that they really do explore, we may actually elect, if you will, to just go in filing a Schedule C, which just means that it's not filing a separate tax return. And therefore, we don't have to worry about basis if there's losses. If we know that, though, a business is really going to launch and they're going to be actively involved, then it makes sense to be an S Corp. Save that self-employment tax, because the net income from an S Corp versus a Schedule C is not subject to self-employment taxes, which is a 15.3% tax in addition to your regular income taxes. If it's going to be an ownership into some kind of business they're not actively involved with, let's say real estate, or they're going to invest directly into another local company, if you will, then that might make sense for it to be a partnership. Of course, that requires 2 owners. Now, if you really are zealous and you just feel as though within 6 months you're going to be launching, raising millions of dollars, you're going to have hundreds of shareholders, if you will, or members or owners, then it might make sense to be a C Corp. But for small business owners, for you, that self-employed, you're maybe taking your gig side hustle and you're now wanting to convert that into a business. Most of the time, if you're actively involved, you might go the Schedule C route to begin, but then pop over and then elect to be an S Corp. But here's what I want you to note is that with an LLC, you can change from a partnership to an S Corp. You can change from an S Corp to a partnership after the first 5 years. You can change from a C Corp to an S to a C Corp. My point is there's that much flexibility also with the tax structure. Let's go to number 7. The term LLC does not need to be on your signage, on your building, on your business card, or advertisements. Now, if you feel differently, then great, good. That's fine that you've included it. But many think, especially when they're first setting up an LLC, that, well, now I got to go get new signage, or I got to get new business cards, or I got to update my advertisements that I've been doing. And so I don't know if I really want to do the LLC. And this would be for that self-employed individual that's really just been out there doing business as, meaning not formalizing their business. But the LLC is a legal distinction, of course. And so, yes, on legal documents, such with the bank or any filings with the government, including the IRS or your state, yes, you would want the LLC to be included in that. When you're signing a lease, whether it's on the vehicle or for where you're going to have your place of business, yes, you would want to have the LLC in there. But there is no requirement that you have the LLC listed for the public, if you will. Now, don't get me wrong. I think it is a nice way to let the public, your customers know, your prospects, that, wow, you know what? They are formalized. They have gone that extra step. They are an LLC. But I do want you to note, there are times I've been driving around and I see the business name and an LLC, and it kind of clouds up, in essence, that signage. Bottom line is that it's not required to be included in things like the signage, business cards, and advertisements. So you can take a breather there, and then don't miss formalizing. Don't miss doing something to save you taxes as it relates to this, in the sense of not using as an excuse any longer, well, I don't want to have to go and update and get new checks, et cetera, just because I've got the LLC. Now, number 6, the LLC taxed as an S Corp requires you file Form 2553 with the IRS to elect S Corp status. Here's the thing I want you to note. Form 2553 is very simple to complete. Now, I'm not recommending you do it by yourself, but it is simple, because really on page 1, you're just listing the information about your business. You're indicating, in essence, who's in control of the business, as in the president or the managing member. On page 2, you're basically saying, when do you want this to be effective? And you have the current owners, even if it's one, sign off and agree to that S election. But then you're just filing it with the IRS. There are really three key times for you to be able to file this Form 2553. The thing to note is that technically the easiest, safest route is to file that within 75 days from when you formalize your business, or from the date that you want it to be effective for, meaning the year. The next, though, is that you can file it with the filing of the initial S-Corp tax return. And then even if you've missed both of those, the IRS has an exception where you can file what's called a late file exception, which is just a statement that goes along with that form that can be filed even after these dates, meaning after the 75 days or after the due date of the S-Corp return. The IRS has made it very easy and has provided a number of exceptions in the event that you missed one of these deadlines. And it's right there in the instructions for Form 2553. Just put in IRS Form 2553. It'll take you to the IRS website. You'll see all the details that you need there. Again, the reason that you want to be an S-Corp, if you're actively involved in this business, what's actively involved? If you really have to ask that, most likely you're not actively involved. Actively involved would be like CSR. CSR every day, unless he is out in Vegas playing cards, being a pro in that aspect. But CSR is in his business every day. Card Shop Reality, great friend of our channel. But he's in his shop. He's working it. That's a sweat of his brow. He is closely involved in that business. That is then, in essence, somebody that is actively involved. Now, if you're just going to put some money in a deal, you're going to own some real estate, that's not a lot of activity for you, okay? Then that might make sense to be a partnership. What's the difference between the partnership and the S-Corp? I've talked about it before. Well, for a partnership that you're not actively involved with, it's not subject to self-employment tax. That is the same for the S-Corp, but here's the catch. If you are actively involved in a partnership, I'm talking about that's how you're taxed. Let me be clear. You can be an LLC, right? You can be an LLC tax as a partnership. You can be an LLC tax as an S-Corp. But if you're an LLC tax as a partnership, or anything else tax as a partnership, and you're actively involved in that partnership, then that net income is subject to self-employment taxes. So what we're trying to do here is come up with a strategy that you're not just laying down on the railroad tracks waiting for taxes to run you over. That's how self-employment taxes can work, meaning whatever the net income is of your business on a Schedule C or a Schedule F, or those that are actively involved in a business that's filing a partnership tax return, that net income is subject to 15.3% in additional taxes, in addition to your income taxes, which is different from the S-Corp, which then by law, regardless of you being actively or involved in your business or not, but that S-Corp does not yield that tax in any way, shape, or form. You want to know what your tax is related to self-employment taxes? Then go to Schedule SE. SE is in self-employed in your individual tax return. And on that form, you will see what you've been paying in self-employment taxes, and then take that to your advisor or your new advisor and talk about the S-Corp on how to, in essence, avoid that. Let's go now to number 5. You set up the LLC at your Secretary of State. You get your federal ID number from the IRS. Many think that when they go and they set up their LLC that somehow they've gotten an EIN number. Now, you may have gotten a account number at the Secretary of State. You might have even been assigned a state ID number for your LLC. But the only place that you get an employer ID number, which is also the same as a federal tax ID number, FEIN, EIN, however you want to call it, is at the IRS. You can do that directly at irs.gov. You just put in online EIN or get my EIN. It'll take you right to it. You can do it online. I don't recommend per se that you do this by yourself, because one of the things that you're doing now is giving some information to the IRS in terms of how you are going to be taxed. And then that can lead you down, in essence, the road on what you're required to file. Now, it's easy to probably fix it, but instead of trying to fix something later, before you even go down the road of informing the IRS of your entity after setting up the LLC or a new LLC, get with your tax professional, confirm what it is that you're doing so that when you're getting that EIN, you're off and running in that direct manner versus avoiding anything to be fixed later. Let's go to number 4. The LLC limits your liability to the assets owned by the LLC. So with that being said, the LLC is fairly new in the history of businesses, if you will. Believe it or not, when I first started practicing back in 1997, there really was no LLCs, at least not in the states in which I was practicing, Texas and then now Oklahoma. In Oklahoma, there wasn't the LLC until the 2000s. So this is a fairly new structure. When I started my business in 1997, my own CPA practice that I still have going, helping clients in the trenches every day, helping with tax advice and planning and all the things that go along into that. But when I started up my practice, there was no LLC. And so I created it as a PC, a professional corporation. But the thing to note is that the benefit of an LLC compared to an entity that has stock, so that's typically an Inc., right? A corporation. See, an LLC, a limited liability company, does not have stock. It doesn't. It's not possible. What it has is units, membership interests, i.e. units. It is not stock. It is completely different from that structure when you have an Inc. or a corporation that has stock. And see, here's the thing, is that in a lawsuit, if there is some liability that is going to exceed the assets of the entity, then that person can, who's suing you or your company, they can take legal, in essence, control of your business because they can take the stock. Stock is an asset that can be taken, right? Now, if you're a professional corporation, i.e. professional, then only somebody in your same profession can take your stock. But nonetheless, when we compare it to an LLC that has units, it's a membership interest. That is something that they cannot take. All that can be done is a charging order against the business that is an LLC. What's a charging order? A charging order just means that there's a standing order that if there's any profits paid out to the owner, then they would first go to, in essence, take care of whatever lien or whatever is owed to that other party, but they cannot take your business. They cannot. See, that's a big difference there. The other aspect is that there's no way to get out of personal liability. So if you personally do something, whether it's fraud or you're maliciously doing something, it doesn't matter how you're structured, you're going to be personally responsible for that. But when we're talking about liability inside the company, right? That's the company's liability. Only the assets tied to that LLC can be used then to take care of any liabilities related to that, whether that's for debt or any kind of lawsuit due to, damage to property, et cetera. Now, don't get me wrong. If you personally sign off on a loan with the bank, then you've chosen to also be personally liable. But what the bank is going to do first is go after the assets of the LLC. But if you didn't personally guarantee a loan on behalf of your LLC, meaning only the LLC signed off on that loan, then the bank would only have recourse, meaning only able to go after the assets of the LLC. My point is there's big differences when you have an LLC in protecting you. It separates out the assets from you personally. We're going to talk about this in a little bit, but one of the things I want you to note is that many of my clients have multiple LLCs, and the reasoning for that is major liability protection. Yes, you may have insurance. Yes, you may really be looking at it as, I don't know if I want to pay another $100 annual fee, or I don't know if I want to do another tax return. I'm going to show you some simple ways around that to not complicate things, but to help limit your liability. Let's go to number 3. You can own multiple LLCs. I've been asked this before. I've done some phone consults and they're saying, hey, can I have more than one LLC? And the answer is yes. And really, in the great country of America, you really can kind of do anything within the law inside your LLC. An LLC can have multiple activities, meaning you could be selling birdhouses and providing consulting services in the same LLC. However, what I recommend to my clients is if they have really separate, distinct businesses, it would make sense to have each separate, distinct business in a separate LLC. So with that being said, you can own multiple LLCs, but also you can have multiple activities in one LLC. Number two, so when owning multiple real estate properties held for business purposes, you can personally own one LLC and then have that LLC wholly own multiple LLCs to simplify tax reporting. I've got a graphic. We're going to walk through this. So I'm not going to spend too much time on this because I'm going to spend a little bit more time here shortly fleshing this out. And this is a very common type strategy that I've been doing with my clients really ever since the LLC came into play. It's a way to protect your assets, protect that multiple ownership of real estate properties, whether commercial or real estate, commercial or residential or land, or even some of your personal assets that are real estate, separating those out. But we don't want to have a bunch of tax returns per se. So I'm going to walk you through a structure that I do with my clients to simplify it, but still have a lot of that liability protection. And number one, having an LLC does not save you taxes. Now, wait a second. JJ, you just been talking about LLCs. So how is it that you just now are making a statement that LLCs don't save you taxes? Well, here's the deal. What did I tell you with number 10? An LLC is your legal structure. It is not your tax structure. So the LLC into itself, okay, that is a legal structure. That's for liability protection. It's for separating you from that business, separating out your assets. But an LLC unto itself doesn't save you any taxes. It's really the next step. And that's what we're going to talk about further in this show. I'm going to flesh out. We're going to go back to some of these graphics that I showed you at the beginning. But before we do that, Amanda, who do we have on with us today? I'm going to turn the mic to you. Who do we got on with us today?
We have God's Dozer.
God's Dozer, as always. Thank you so much. Hope you're doing well, sir.
Kevin Hawthorne.
Kevin, good to see you. Thanks for being on.
Rob from Imagine That Choice.
Rob, I'm going to see Rob here probably tomorrow in Oklahoma City. Looking forward to that.
Mike Fisher, CPA.
Oh, Mike Fisher, CPA, wonderful fellow friend, CPA out in California. Hope you're doing well, sir.
Sarah Kay.
Oh, Sarah Kay. I think Sarah down in Houston area, I believe. Thanks for being on today. Hope you're doing well.
We have Greg. Roll Tide.
Greg Roll Tide. Yeah, Greg was one of about 76 people that got to see a video that came out on the 4th of July. Greg said, well, I can hear it now, but I wish I didn't see it. And after that, I let it play, and then I just took it down. And we kind of did a different type of presentation of that. I was jumping in the pool, and anyways, Greg, I took it to heart. Hope you're doing well, my friend.
Brian Ward.
Brian, how are you?
And Kelly Thomas.
All right, we got Kelly on with us. Thank you so much. Appreciate everybody being here today. So let's flesh out. I want to walk through the word on LLCs. Is that, again, just to throw this up here for you, LLCs are your legal tax classification. Oh, I'm sorry, is your legal designation, not your tax classification. I want you to hear those words very distinctly. You have a legal designation. So you have now a birth certificate. I created a business, Secretary of State. Now you do a tax classification, and that is only chosen at the IRS. The Secretary of State does not communicate to the IRS that you are now a partnership or an S Corp or C Corp. There's nothing that you do at the state level. Let me repeat, there is nothing that you do at the Secretary of State, no matter what you were told, no matter what you think, no matter what you dreamt, that in essence selects how you are going to be taxed. And the state is going to then follow however you have elected to be taxed up at that federal level. Now let's kind of talk about how you do save taxes once you now have your LLC, right? So really kind of this structure here is that you have an S Corp, which files a Form 1120S. You have a partnership that files a Form 1065. These are separate tax returns. These are separate filings with the IRS, and then down at the state level, however that applies to you. But this is filed separate and distinct. The thing I want you to note is that there is no tax at the S Corp or partnership level, meaning it's a flow-through entity. So those arrows pointing down to the individual, the Form 1040 that you file, is that whatever the net income is of the S Corp or the partnership, you pay tax on it down at the individual level. Those tax rates range from 10% up to 37%, depending on your status of filing, meaning whether you're single, married, filing jointly, filing separately, head of household. Depending on your income, the bracket, those things are graduated. Now you have the C Corp, and that is a 21% bracket. Okay, let's go ahead and take that off. Yeah, so that is a 21% bracket on the C Corp. So right off the bat, many say, oh, well, I think I would want to be a C Corp because I want to pay tax at 21%. So let's bring that graphic back up that shows that. The thing is that whatever that C Corp nets, it's going to pay 21% tax on that. But see, then when you go to pull the profits out, which as a C Corp would be a dividend, you're going to pay tax on that dividend at the individual level. For most, that's going to be 15%. For many, it could be also 20% plus another 3.8%. I'm going to add this up for you real quick, which is the corporate level of tax on the net income is 21%. But if you're paying tax on you pulling out now the profits, those dividends, even at 15%, that means that pretty much at a low dollar amount, you've collectively paid 36% in taxes. The business paid 21% and the individual then paid 15%. That's 36%. There's no way that makes sense. And guess what? If you happen to be then in that upper tax bracket, you might be paying then 20% on your dividends, plus then another 3.8%, which would put you at 44.8% in taxes. Bring the graphic back up. The only time that it really makes sense to be a C Corp is when you're required to be a C Corp. See, I've told people recently that when the IRS requires you to do something, that's most likely your signal that it's not typically in your benefit to do whatever it is that is then required by the IRS. Meaning if you're required to be accrual basis on your accounting, typically that's a big signal that it's not really going to be in your benefit. So when we are talking about though, then saving taxes, it really then for small business owners, once you're an LLC, you elect to be an S Corp or a partnership, then the tax planning really comes up at that level. We'll bring that graphic up one more time. So see, at the S Corp level and the partnership level, the deductions that you can come up with there, okay, that is then what in essence saves you taxes down at the individual level. Let me be clear. The S Corp and the partnership, they don't pay any taxes, right? But then whatever that net income is, that is then picked up, reported by you, the individual on Schedule E, page 2, and you then pay individual taxes on whatever that amount is. So the lower the net income is from the S Corp or the partnership, then the lower the amount that you are going to pay regular income taxes on. Now, when it comes down from an S Corp, meaning whatever the net income of the S Corp is, and you're paying tax on that, then you would be in a position where you would not be paying self-employment taxes. The net income from a partnership that goes down to the individual level and you pay tax on it there, if you're actively involved, it's going to be subject to self-employment tax. If you're not, then it's not going to be subject to the self-employment tax. All I'm trying to say here is that those are really your two main go-to type tax structures for really any business. Many that want to file a Schedule C, I told you earlier, it's really because they just started out and maybe they're expecting losses and they want to be able to take those losses without any concern of having them limited due to tax basis or at-risk basis. That could be a simplification. But I don't have any clients that file a Schedule C except two. I don't have any clients that file a Schedule F, and I don't have any clients that report their real estate activities on Schedule E. 0 clients that I work with, thousands and thousands of small businesses over the years. If you own real estate, I have you with your attorney set up an LLC. We elect for it to be a partnership, and there is a separate filing of that tax return. We don't file anything for our clients on Schedule E, period, the end. We don't do anything with Schedule F. Again, that Schedule C is really for those that are just starting out. That's why I only have 2. And guess what? Most likely with this next tax filing, I won't have any Schedule Cs. And guess how many C Corps I work with now? 0. I don't have any clients of mine that are C Corps. And you bet your bottom dollar, I've run the analysis. Now let's talk about this tax structure here when we're talking about owning multiple LLCs. So the thing I want you to know here is that an S Corp can own an LLC, a partnership can own an LLC. So in this example, I'm talking about when we have everything really owned by the same person or the same family or the same owners, the same shareholders or the same partners. So let's talk about that partnership side. So if you own multiple pieces of real estate, let's say as a prime example, then I would have the client have a partnership. That's the main entity, as I was telling you in our top 10. But then each real estate property that they would buy, we would have them set that up and own it in a separate LLC. It would get a separate EIN, but it would be wholly owned by the partnership. And then for tax purposes, it is disregarded. Now, what does disregarded mean? Disregarded means that it's not filing a separate tax return. That's all disregarded means, okay? That's all disregarded means. So when you have a business that wholly owns an LLC, that LLC simply doesn't file a separate tax return. It still has a separate identity. It still has a separate EIN. It still owns things separately. But see, inside that LLC, as I was telling you earlier, the liability is then limited to that specific LLC. So if I have a client, they own 3 real estate properties, what we would be doing is each LLC would own each separate and distinct piece of property. And why? Because that LLC that owns this one piece of residential rental property, then the liability is contained to that LLC. And then if they have commercial property or another piece of residential, it's owned by a separate LLC. But see, these 2 separate LLCs, this property can't be used to take care of this property's, in essence, liabilities. Everything is contained. And then by having that, let's pull that graphic back up, by having then a master LLC, the master partnership, as you call it, and I'm using that as my own word. There's no terminology called master. There's nothing like that, okay? I'm using it as like a parent, okay? But then that one LLC taxes a partnership, or that one LLC taxes a C Corp, as an S Corp, is going to then report the activities of these LLCs that it owns. Okay, this sounds complicated, and it's not. It's very easy. It's very simple. What's more complicated is if you had 3 LLCs that each owned its own piece of property, and you had 3 separate bank accounts and 3 separate tax returns and 3 sets of QuickBook data files and 3 sets of financials, etc. That gets complicated. When I put this together and been doing this with clients for a long time, we have one main entity, that LLC. We elect how it wants to be taxed, but then it can own other LLCs. And when it wholly owns it, what's wholly owned mean? It owns 100% of that LLC. Then the IRS says, for IRS tax purposes only, it is what's called disregarded. And all that means is it doesn't file a separate return. Well, how do you report, though, that activity? Because you do have to report the income and the expenses. You simply report it on the main LLC tax return. So that partnership, the one in red, the graphic that I showed you, that tax return, that Form 1065 is going to show all the income and all the expenses of all the LLCs that it wholly owns, because there's no separate filings for those separate entities. See how that makes this a little bit more easy, in my opinion. And the reason I say that is you really can have one bank account. Now, if you really want to go to extreme, you certainly can have separate bank accounts for each LLC. You can have one, in essence, parent company that manages everything, if you will, with one set of financials, one set of tax returns, and therefore you're simplifying this, but then limiting out your liability. Now, with this being said, The other thing is, one other thing in that graphic, if we can pull it up, is you then can run through this income that goes down to the individual level through whichever entity makes most sense for you tax classification wise. So let me tell you this. I'm telling you right now, of all the clients I work with, if somebody is actively involved in their business, there is not one of my clients that is taxed as a partnership that is actively involved in their business. Not one client ever that's actively involved in their business do I allow them to be taxed as a partnership. In fact, I brought on a new client and I fired them very swiftly because they were a partnership. They were actively involved. And I said, hey, we can flip you right over to an S corp. Pretty simple. We sign these forms. You're done. It's simple. And they dug in their heels and they had all these reasons they wanted to stay as a partnership. None of them made any sense to me. And I said, well, guess what? You're fired because this doesn't make any sense to me. And I'm not going to prepare a tax return for somebody that is actively involved in the business and then, in essence, paying more taxes than they really need to. The thing I want you to note is that for every single solitary client that I work with, 30 years of experience, all of them, if they're actively involved, they are an S corp. Why? Because we don't then have to pay self-employment taxes on net income. So with that being said, it makes it pretty simple. Partnership is really key for not actively involved, which means really real estate, right? Because you're not actively involved in real estate. It's really hard to be, right? And when you talk about the real estate professional and the 750 hours, guess what? That has nothing to do with owning real estate in an LLC, taxed as a partnership, or owned by another partnership. That never, ever, ever comes into play. If you think it does, then go back and revisit the rules. Go back and visit with your advisor, because the only time the real estate professional designation comes into play, that's the over 750 hours, kind of the main rule to determine if you are a real estate professional. The only time that that comes into play is when you are reporting real estate activities on Schedule E. And that's why I told you earlier, I don't have one client that we report real estate activities on Schedule E. Ever, ever, ever. Never do it. Because I don't even want to have to mess with those rules. What I want to do is just worry about what are the LLC rules. So you can be actively involved in an LLC and therefore be actively allowing, let's say, losses or having active income. Whereas with a Schedule E reporting your real estate activities, it pretty much is non-existent to be able to say that it's, in essence, it's active. And it's really going to have then just this, the classification of being passive. So I'm kind of getting in the weeds a little, but for those of you that if you're really getting into real estate, you have multiple real estate, I don't care what you say, you're really shooting yourself in the foot by reporting your activities on Schedule E. First and foremost, starting with, you're really now handing the bank, you're handing a jury in the event of any kind of lawsuit, your entire financial picture, because you have to give them your complete individual tax return. You're now under the rules of Schedule E, which are much stricter. When you're talking about vacation rentals or rentals that you're using maybe a little bit personally, the rules are vastly different when you're filing a Schedule E. There are similar rules to these activities, even if you're filing an LLC, but you're really going to find those advantages when you are an LLC, then taxed as a partnership specific to the real estate. So what's your course of action here? If you are somebody that has multiple entities and you now want to look at simplifying things, well, here's what I would say. So to my clients that would come to me and they'd have multiple entities, let's say in the real estate, or they have multiple entities, and I'm like, you know what, let's simplify this down. Why don't we have one main entity? So it sounds like we're getting ready to create new work. And if you're worried about spending another $100, then you probably haven't been in business long enough to really realize spending another $100 at the Secretary of State to set up another LLC is massively, massively worth it. But the reason I say you set up a new LLC is you're setting up a new LLC, it's fresh, right? And what's the role of this new LLC? It would be to wholly own these other LLCs that you have. So you would create it, you'd set it up, get an EIN. If you're actively involved, then it would be an S corp. Now, I'm going to tell you this right now. The clients that I have that have a lot of real estate, they have an LLC taxed as an S Corp, and then that S Corp owns all the LLCs that then own the real estate. The second thing you would do is then assign the ownership of the existing entities to the new LLC. Pretty simple, right? It's just assigning the ownership. It's not selling it, it's assigning it. And if it has the same members as it does when you assign it, then there is no tax ramification at all. Maintain. So step 3, each existing entity continues to maintain everything the same with no change to existing books, payroll, and bank accounts. All that's going to do then is number 4, annually combine the activities into one set of high-level financial statements in a simplified manner to then number 5, report combined financial statements on a single tax return. This is not considered a consolidated tax return with what I'm talking about. So why am I getting to all this? So what I have really been preparing with my clients the last couple of years, and really even before the pandemic, we started down this road. The CARES Act put a number of things on hold, if you will, such as the excess business loss for starters. But what I'm telling you is that many of my clients had multiple entities, but we've been moving in a direction of really having that client own one entity, and any other entities that they own, we have that one entity that they own those other businesses, own those other entities. And see, that's the beauty of the LLC. The LLC can own an LLC. Now, an S Corp can't own an S Corp, right? I don't want to get too in the weeds here with you. That's why you got to have a tax advisor working with you if you got multiple entities here, but the simplification and why. Now, first and foremost, if you don't know me very well, what I need you to know here is I'm a certified public accountant. I'm not a YouTuber. Okay. I do love every single one of you that are tuning in. I consider you my friends. I appreciate everything you do. Over 80,000 subscribers, you'd say, oh, this guy must be a YouTuber. I'm a certified public accountant that's putting videos on YouTube. And the long and short of this is that I'm a public servant. All that means is, as a certified public accountant, I have a duty to the public, whether I know you or not, to give you the best information. I'm going to tell you this, I'm not liable to you because I'm a CPA, but I'm not your CPA, unfortunately. But what I'm telling you is, here's the deal, okay? And you can't overthink what I'm getting ready to tell you. But there's more audits coming, right? Big deal that there's IRS audits. Who cares if we have IRS audits? You know, as a tax professional, you know what IRS audits are? It's more fees, right? I mean, I'm not scared of the IRS. They keep me in business. They're kind of like my, in essence, job security, if you will. The beautiful thing about the IRS is that they put all their rules, all their regulations, their laws, their instructions, everything is on irs.gov. Even when you get audited on irs.gov, they have to produce, in essence, the audit guide, meaning here's how they plan to audit you. Here's what they plan to look at. Here's what they're going to ask for. You know, the IRS just announced that they're hiring more auditors. Big deal, right? So what I'm trying to tell you is big deal that there's an IRS audit. Okay, this is me knocking right now. No one's knocking at your front door. I'm knocking here. 30 years, I've never had an IRS adjustment in any IRS audits on any tax return that I prepared. And here's why. Okay, it's working first and foremost with good clients. It's second of all, working with clients that are going to make sure that they have documentation from their minutes or to the operating agreement, making sure that their assets are titled properly, that everything's running through their bank accounts properly, they're reporting all of their income, we're having a relationship, and they're interested in, we're ensuring that any deductions that they're taking are related to the business. They have receipts, right? We have everything backed up. But the key here that I want you to note, though, is that as a tax advisor, as a certified public accountant, just the same as my other enrolled agent friends and other tax pros that have been doing this a long time, if we can take actions that really, in essence, help our client, make it simpler, make it easier, then I feel we have a duty to do that. And with the IRS and the LLC and how that has evolved over the recent years, it really just makes more sense for filing purposes with the IRS to see if we can't really consolidate things down. How does that apply? It's getting things down to less tax returns. Because I'm going to tell you this. I have a client, and he has been a client a long time, and he owns over 40 businesses. So we really could be like, well, how many tax returns do you do? Well, they have multiple owners and this, and this. But here's what I just want you to know. Here's your takeaway. This client gets a W-2 from one entity, and it's the S Corp that he owns. And then he gets one K-1 from the S Corp that he owns. And then he owns everything through the one S Corp. So his tax return is extremely simple. And this is what I want you to hear. His tax return is completely verifiable at the individual level when you go to the IRS and you look at how, in essence, audits are then selected, which is information that maybe they're not aware of. There's always, in essence, this mindset of, well, high-income individuals, they're going to be more likely audited. The only reason for that is that if there's an adjustment, there's more tax to be collected. The IRS is just being smart about it. But what I'm getting at is that for this person, believe it or not, at the age that they're at, they don't have a mortgage anymore. So they have a standard deduction, meaning they don't even itemize their deductions. We don't have to show the real estate taxes and the charity and all that kind of stuff. He has a standard deduction. He has some interest. He has some dividends. He has some stock sales, has a little bit of Social Security. He's got one W-2 and one K-1, fairly simplified individual tax return. But then up at the S Corp level, okay, that is where then everything comes together. And of course, we're breaking out basis. We're breaking out whether it's passive or active. We're breaking out at-risk basis. We're not at all using this in a way, in essence, to take advantage of the tax law incorrectly. And in some ways, it's not even really an income tax play, if you will, because it doesn't really do anything to save him taxes. What it does, though, is simplify down that individual tax return, which then reduces, in essence, audit risk. Because if this client got audited, guess what? I would just make money, in essence, representing. There would be no adjustments. There just really couldn't be with this client. I don't work with any clients that I would expect any adjustments that would come into play. But it's about simplifying it down. But what we don't want to, in essence, have there be any cost to is protecting the assets, protecting the businesses, which is still then having that liability protection. Now, this client that owns those multiple businesses, some it wholly owns, but there are others that he's invested into businesses. So he gets a K-1 from another LLC, but he doesn't own 100% of it. It also simplifies down, in essence, the reporting. So down at the individual level, we have a line item for passive. We have a line item for non-passive. We're tracking the basis differently, but it really does simplify that all the way down. Well, hey, I really appreciate you. Thanks for tuning in. I appreciate you being a part of this channel. I appreciate all the support. We hit over 80,000 subscribers. I'm doing a live show every Monday, 4 p.m. You know that. I appreciate all the love and the encouragement. I do plan to, as we go into the fall and into the winter and go into year end, releasing some direct seminars that you'll be able to take advantage of. I have an employee retention tax credit seminar right now that you can get instant access to. I do a monthly continuing professional education seminar for 1 hour for CPE for those that are interested in that. And even if you're not interested in continuing professional education, because you're not a tax pro, you still can take it. So I have links in the body of this video to both of those things. All right. Hey, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. Have a great one.